Jason Fernandes, COO and co-founder of AE Token, joins us on the line to take a look at the US financial markets and the crypto space. So Jason, thank you so much for joining us on the line.
Thank you very much.
You're very welcome. Now, so we're going to jump straight in here because what we're seeing here is a really interesting topic about a new report that states cryptocurrencies aren't a threat to the US market. So if we look at the US financial markets and the financial sector, this is a massive $18.4 trillion sector. If we compare that to the current stats of cryptocurrencies, around $113 billion. Do we see that actually, looking down the line, in your opinion, that the cryptocurrency markets can make a dent in the financial markets in the United States, or are they two completely different worlds?
So I would say that they are two completely different worlds. The issue of contagion was first raised by Ives Mersch, who is like an executive board member of the European Central Bank. He referred to cryptocurrencies as potentially having a risk of contagion and contamination. And that was echoed by Augustine Carstens, who is the general manager of the Bank of International Settlements. He voiced the same concerns that quite hasn't gone to the United States yet. But if you think about who these people are, Carstens has previously said that Bitcoin is a Ponzi scheme. So a lot of this criticism is actually coming from people that are crypto skeptics to begin with. So you really have to consider the source. If you consider the amount of money that was raised by IPOs in 2017, that was $95 billion. Now you compare that to the amount of money, just the entire market cap of Bitcoin, we're looking at 113 billion. So to say there's a risk of contagion is kind of ridiculous because you're talking about like what the IPO market would raise in 1 year.
And you mentioned contagion there. Let's focus on that a little bit more, because something that's really interesting about this is if you think the issue of contagion in the markets have kind of spread to crypto trading platforms, or if it's not yet been seen as an issue.
Whether the financial markets has actually affected cryptocurrency markets.
Yes.
Yes, actually, there seems to be some sort of relationship between how the markets behave in general and how the cryptocurrency markets behave. There are some unique factors, though, that affect the cryptocurrency market. I think the main unique factor would be the hacks. So when you have these security hacks, when people hack and steal a bunch of bitcoins, those bitcoins are going to end up on the market, and that's gonna increase the volatility. So that's something that affects the crypto market, which is independent of general markets. But we do tend to see some sort of trend with how the markets are behaving both in Europe and the United States and in cryptocurrency in general.
And for people that are in the financial sector, or maybe not, that haven't heard of the phrase contagion before, how would you explain it to people that aren't particularly aware of what it is?
So I guess the concern is that when you have major volatility in the crypto markets and you have people selling off this sort of the fact that there's so much overlap between the crypto world and the regular world when you have banking intertwined. So you have like credit cards, people using credit cards to buy crypto and stuff like that. There is a danger that when if the crypto market were to crash, that would lead to follow on knock-on effects in the general financial sector. I think in most cases it's the other way around, because if you look at the size of the crypto market, it's so tiny in comparison to the rest of the financial industry that I highly doubt that one could have an effect on the other. In fact, I think it's more likely that the financial markets, could negatively affect crypto. Because if you see how crypto has been incredibly volatile, it hasn't really been elastic to some of the good news that's come out of crypto, and I think that's because of the general financial, just seen generally in the financial markets overseas.
Yeah, absolutely. And you kind of argue as well that if we saw the bull run of 2017, there was also a massive stock market rally in the United States as well. So around the Christmas time of last year, we saw a green across the board in the crypto market and also in the stock market as well, in the S&P, for example. Thank you so much for your insights so far. We'll join with you later on in the show to touch on this a little bit further.
This is Blocks Live TV.
Is crypto a threat to the US markets? That was a recent report published. I'm joined by Jason Fernandes, COO and co-founder of AE Token, to take another look. So Jason, I think the big question here, we've touched on how volatile the markets are. You've highlighted the phrase contagion, which is kind of being thrown around the markets quite a bit. If we look at regulation, if regulation was in place for the crypto markets, we're hearing that 2018 there's been a high demand for regulation in place. It would provide a lot more of advancements in the space. Do you think actually this would overcome the issue of contagion that we are seeing as a bit of a fear in the crypto and financial market space as well?
I think regulation, in most cases, of course, it would help prevent scam ICOs, but it would also, I think, a lot of regulation could be focused on IT security. So prevention of these large-scale Bitcoin hacks and exchange hacks would prevent having like a lot of these tokens out by people that have gotten it illegally and are trying to like essentially dump it onto the market. So that would increase volatility in the crypto market. So I think that in the next year, as more regulation starts kicking in, you're going to start seeing less scams and therefore less volatility and therefore less risk of contagion to the general financial markets.
And it almost seems to be the case that when we do look at the hacks and security surrounding cryptocurrencies, that actually it's not the coins as such, it's the exchanges that hold the coins that normally pose the bigger risk. If we see a large Bitcoin hack on a specific exchange, for example, then we will see some price implementation and some price action following this. So really, you're saying that actually exchanges should be a little bit more cautious. There should be regulations to protect the exchanges, and that in turn will protect the market volatility as well.
Right, exactly. So I'm saying that with increased regulation, both to prevent ICO scams and also to prevent these hacks, that increased regulation will result in less volatility and therefore less risk of contagion.
And on a second note, so now that we are on the topic of exchanges, let's talk a little bit about leverage. So leverage is becoming popular in the financial markets. Has this also kind of come into the cryptocurrency space as well?
Yes, it has. So there are several exchanges that allow you to leverage crypto trading. But a lot of them have very stringent rules with how exactly you're able to do this. So, for example, GDAX stipulates that corporations and organizations have to have a net worth exceeding $1 million or assets exceeding over $10 million in order to enter into like margin trading in connection with business. In contrast, you have like companies like Kraken, exchanges like Kraken, and essentially the way they function is they have various different tiers depending on how much money you're trying to put in and invest. And as you access like higher funding tiers, you have to provide more documents and more proof of funds. And essentially, they Kraken, for example, it gives loans ranging from 3,000 euros to like 100,000 euros, but depending on how much documentation you're able to give them. So yes, it is increasing, but no, I don't believe it will become a problem because exchanges are being very smart about who they choose to let use leverage trading.
Fantastic. Well, thank you so much for your insights so far. We'll join with you for a final time throughout today's show. Thanks.
This is Blocks Live TV.
Crypto markets and the US market, while Jason Fernandes, COO and co-founder of AE Token, joins us on the line. So Jason, throughout today's show, we've touched on some of the issues in contagion regarding the financial markets and the bridge between the financial and the crypto markets. On a final note, I think it's only fair that we touch on adoption of the crypto markets. 2018, there has been a lot of growth when it comes to other companies using cryptocurrencies. We've seen a lot of talk. It has become something which is a little bit more of a household name than it was, for example, 2017. How do you envision 2019 on regards to adoption? What do you think needs to be put in place to see some growth in the market and to see some some more comfortability with the general public?
I think all the legitimate ICOs are craving for some degree of regulation because I think regulation will increase the level of safety that people feel when they invest in cryptocurrencies. So the more safe they feel, the more regulated it is as a market, the more likely they are to put in money. So I think over the next year you're going to see more regulation kicking in, more ICOs that conform to that regulation, and therefore increase investor trust. in those ICOs. So you're going to start finding cryptocurrency to be as legitimate as an investment as like in the stocks or something, and as safe for a lot of people. And as that starts to happen, you're going to see like much larger trading volumes, and also much higher market caps, because people are going to have going to be feel safer about putting money into cryptocurrency with regulation.
And do you think that will also be a cause for price stability as well? If we see some large-scale US investors, for example, that normally invest in the financial sector, move over to investing in crypto, are we going to start to see a higher market cap, but also some more market stability if we see some large-scale investors leveling out the playing field, as it were?
Yeah, absolutely. I think one of the main things that's keeping a lot of large investors out of this market is the lack of regulation. So as regulation increases, you're going to find a lot of institutional investors get into the market, and that will be the signal for a lot of individuals to put in their money as well. So and also you'll see a lot of decisions with Bitcoin ETFs and other funds that are coming out. And once those things start becoming a reality, and more people start using them, you're going to start seeing people feeling less afraid of investing in cryptocurrency. It will first start with the institutional investors. Once they see regulation coming in, and then it will sort of spread to private investors.
And if we start to see things like EFTs come into the space for larger coins like Bitcoin, is that also going to help with people's familiarity of moving forward in adoption as well?
Yeah, I mean, it'll feel more like a financial instrument than it does now. I think a lot of people look at crypto right now as sort of like a high tech thing for like nerds to get into or something. But I think once you get greater market adoption by institutional investors, people start seeing it more as like as just one of the ways to hold their assets. So they might hold a certain degree of their assets in gold. They might hold a certain amount of their assets in Bitcoin, for example, or other cryptocurrencies. You'll start seeing that more as regulation comes in, and as institutional investors start coming into the thing.
Fantastic. Well, Jason, thank you so much for your insights. It was an absolute pleasure to have you on the line.
Sure, thank you very much.
Thank you.
This is Blocks Live TV.